Perfect. Okay, here we go. All right. Happy Friday, guys. Thank you for coming to our webinar, The Roadmap to Buying a Home with Financing. Uh, right now, I'm going to go over the roadmap and I'm going to go over programs, the financing process, and the way we have to do it now. I mean, now that the market is very, very hot, especially with financing, I want to show you guys this roadmap. Uh, I'm going to talk a little about myself real quick. My name is Jose Mata, and I'm a branch manager from Point Mortgage Corporation in Doral. I've been in the business since 2006. I started when back then was the heyday, when just kind of the same amount of volume we have now. But back then, the financing was a lot different. When I entered 2006, back then it was the programs were a lot different. There was not that much verification. So a lot of financing, a lot of transactions. Fast forward now, we're here, and I believe this is the heydays that we live in 2020 with financing. So this is what I do full time. My bread and butter is working with real estate agents. That's what I've been doing for the past 15 years, learning the craft, the financing, the program, helping real estate agents how to understand financing because it's a lot of moving parts. Yes, the process is the same, the qualification is the same, but if you're able to have someone qualify, approved from the very beginning, you're going to have a successful closing. And I want to show you the steps. So this is what I do. I like educating, especially in financing with real estate agents it goes hand in hand. That's the bottom line. That's if you have a great relationship with your lender and you guys are working as a team, communication, then you should have a great closing rate at all times. Okay. So let's jump to the topics. I'm going to go over the roadmap to buying a home with financing. I'm going to show you an image and how I want to show you the road. We're going to go over the successfully how to complete the approval process. What's the difference between FHA conventional loan, especially now where there's a lot of demand, it's a seller's market, it's a multiple offers. So you want to have a strong financing, even with FHA. So we're going to go over that. The veteran loans, VA loans. VA is a great loan to help VA veterans. And I want to go over the breakdown, the benefits that you can help a veterans, how to, with financing. So you don't have to neglect it. I want to show you the breakdown of the mortgage payments. How do we qualify someone, including, and I want to show you the breakdown, how do we go about it? How to increase your credit score. Right now that we see a lot of buyers that want to get qualified, but they're having challenges with credit. So I want to go over with that. And last, have your questions ready. So like that, we will go over and I can answer all your questions as much as possible. Okay. So let's jump right in it. And let's go to the roadmap to buying a home with financing. So this is what I want to show you guys, that once you have someone that is interested in buying a home and they go online, they go in Zillow or these websites that they're interested in, they have this, they're telling their wife, I want to buy a home. 99%, I say 98% of the time, they'll call the real estate agent hey, I'm ready. I'm a first time buyer, or I have my home and I want to be able to sell my house, buy a bigger home, because there's a motive. When someone has a home, wants to buy a bigger one, or they want to go to different locations, it's a motive. So you have to be ready and ask those questions. So this is the roadmap that I want to show you. It's never a straight line when it comes to financing. With cash deals, it's different. With financing, it's a lot different. But if you master all the steps from the very beginning, you're gonna be able to have a better closing rate. Okay. With financing, yes, there's a lot of moving parts when I said, but if you're able to know the terms and the process as a real estate agent, you're gonna be very successful. So let's start with number one. So yes, number one, you have someone is interested. I think you guys know already. You shouldn't be going out and show properties. Spend your time and show houses, because yes, you might think they qualify, they're approved, they have the cash or they have the credit, but if the lender hasn't analyzed the documentation or done an application, then you don't have 100% approval. Like I said, especially now, we're in the market that multiple offers. So the listing agents are required just more than a pre-approval letter, right? So I would, and I recommend for you guys, even if you know someone is fully approved, to go through the process, not just a pre-approval call and say, well, what's your credit score? What's your income? Okay, you're good to go. Because you don't know if once they show the documentation, if this is someone's going to close. Okay. So if you guys are working with buyers, I would suggest to get it, for them to provide the documentation. Very simple. Provide your income, provide your asset, and let them run your credit. Yes, there's people out there that want to be, no, I don't want to run my credit. It's going to hurt my credit. That's not necessarily true. Not for mortgages, because the consumer has the right to run the credit when they're shopping around for a mortgage. And that's online. You could Google that. So this is not going to impact the credit unless they have done a lot of activities prior before. If they had gone out and buy a car, applied to multiple credit cards, they're maxed out. So yeah, maybe that can impact the credit. But if they're just shopping around for a mortgage, it's not going to impact the credit. So I would suggest for them to go through the process on step number one. So once you have that approval, though that pre-approval, you want to read the letter that says it's not subject to all the documentation. You want to make sure that credit was run, analyzed, debt to income ratio, assets, and income. You want to make sure you have the income, because remember, and I'm going to go over with the programs because there's a lot of self-employed borrowers that they do make money. Now, do they declare the income? That's the big question. So you want the lender, whoever you're working with, to analyze, to read the taxes, go with the 1120 corporate taxes, 1040 personal taxes, W-2s, most recent pay stubs. Because remember, in March, after COVID-19 started, there were people that were laid off. There were people who were furloughed. Now they're coming back. So the lender has to make sure that they're going back to earn those hours full time, or they're part time, or they're just on call. So the fact that they made $60,000 a year before, and now they're coming back and they're making half of that, that doesn't mean that they have to qualify with 60,000. You have to qualify the borrower with the present income. Okay, so there's commission buyers, there's buyers that they probably were waiters, they will work with tips, and if they don't get the same amount of tips of income, then we're gonna have a challenge. So the lender that's doing the qualification have to make sure that your debt to income ratio, when you present an offer, you want to make sure that there's not gonna be any hiccups. Like I said, the roadmap is a very curvy road. It's not a straight line. So a lot of things can happen if step number one is not done correctly. Then you're gonna have it's not gonna be just it's gonna be a nightmare, driving around the roadmap. You're gonna get lost, you're gonna come back, it's not gonna be a pleasant ride. So you wanna be focused, even if it takes 24, 48 hours to get to the pre-qualification or approval, just give them time. Right now, there's a large volume on refinancing them, purchase. All lenders, I'm talking about all lenders, banks. So if that loan officer needs to take a little more time to qualify your buyers, even the time, in 24, 40 hours should be done, should be qualified. So once you have that ready, what's the next step? Step number two. Well, it goes back to you, real estate agent. You get the approval letter and get the DU approved. If you're able to get a DU approval, and whoever doesn't know what is a DU approval, is desktop underwriting. That's an automated underwriting system that lenders provide. I don't know about big banks that provide DUs, but I know that lenders and mortgage brokers could provide you a DU approval. This is all the information that we gather, like the pay stubs, bank statement, credit, all that information that we gather, we're going to put them in an underwriting system with Fannie Mae. And just depending on the scenario, say you need a DU for a property for 450,000, we're going to run it through and we're going to get the approval. If you get the approval, then we'll go send it to you. Like that, you're presenting a stronger offer, especially now that the timing, the amount of buyers that you need to have approved, that's the way you're going to have to send it. So step number two, what do we have? So you're approved, you get the agent, you have the agent, you start shopping for a new home or for a retail home. So they're excited, they're looking, you guys found the property through the zip code, or anything that they're looking for, you find the right home, you make an offer. And right now the offers are strong. You cannot, I've seen offers that you have to now, offer full price and above. I've seen it. I mean, most, it's happening. It's a seller's market, like I said. So your offer has to be strong. I would suggest also to write a letter, send a picture, like a cover letter showing the family picture, a sentimental, something that connects with the listing agent, and you give them more value, more ammunition to be able to, because right now people are qualifying. It's not like before we had the challenge of the banks are not lending. The lenders are not lending. It's not closing. Well, guess what? There's a lot of people that are getting approved. They're qualifying FHA, they're qualifying conventional, they're giving 20% down, anything of that reason. So they're qualifying. I've seen it. So there's a large volume. So your offer has to be strong. It has to be ready. Whatever the listing agent asks you, do it. And if once the property comes out of the market, don't wait 3 or 4 days to show the property. You're gonna be fighting for for a lot of multiple offers. So I try to beat the time, to beat the time so you can be number one. Now, once the offer is accepted, the executed contract goes back to the lender. Okay, so once seller and buyers executed the contract, you're going to send the executed contract back to the lender. Okay, so once the executed contract goes to the lender, guess what happened? Guess what happened? This is when we're gonna start processing the loan. Okay, this is when we're gonna order title. This is when we're gonna order appraisal. And once they have the inspections ready, like the 4-point mitigation, also send it to the lender so they can start looking for insurance quote. This is the step number 3. A lot of lenders or a lot of loan officers, they tell me, or realtors, that they're doing that process halfway, almost at the end. The lender must order appraisal and title the first week. Once you have that contract executed. If you don't have a contract executed, the lender cannot order that. I want to make that clear. So once we have a contract executed, you want to be able to continue moving forward. The buyer already signed the application. The buyer already know the numbers. One thing that you have as a real estate agent, you don't want to be, when you get involved with financing, I'm not telling you to gather the documentation, send it to the lender. You let the lender do that for you. Okay. Remember, we're working as a team, hand by hand in this roadmap that we're talking about. This is a team, obviously, with your title company as well. So you want to be involved, but you're not going to be the getting the documents, qualifying the buyer. That's not your job. You want to understand the process. You want to let the lender handle that, the application, the estimate. Very, very important. You want the buyer to make sure that they know the interest rate. You want to know the payments, and you want to know the cash to close. Because if they don't know that and they rely on you, then something was wrong on step number 1. Step number 1, you're supposed to have the numbers ready. That the program, what am I getting into? Am I getting into a conventional loan? Am I getting into FHA? Why am I doing FHA if I have great credit scores, right? So those are the questions that you got to have that communication with your lender, the reason why they're in that program. Ask questions. Just not let just the lender handle that and just forget about it. I would just ask, and find out, because if the buyer is ready to go, you have the approval, they know the mortgage payment, they know what they're getting into, your process is going to be a lot smoother. So once step number 3, and they complete the loan application and it's signed and disclosure, the process is going to send the file to underwriting because they already have all the documentation when we did the approval. That's the same documentation the processor is going to have. Yes, they're going to do the verification of employment. Yes, they're going to do the verification, different verifications of the processor. But once they have the loan already, it's going to go to step number 4, which is the conditional approval. This is when the underwriter reviews the file, the full file, including appraisal, and it's going to give you the conditional loan approval. The famous commitment, I need the commitment. I need for you to give me the commitment, right? Yes, the conditional approval is the underwriting commitment. It's the same thing, it's just a different terminology. Okay, So once you ask, because I know in your contract, you must give a loan approval, loan commitment in 20 days, 30 days, whatever the date you guys wrote, that's the conditional loan approval. And that is going to give you conditions. That's when the loan is approved. That is when the loan is fully approved, but it's going to give you conditions. By the way, guys, this presentation is recorded and I will send it at the end. Okay. So don't, I'll send also the presentation so you guys can have it. So once the condition approval is approved, that's the loan being approved already. I want to make that clear that you're going to have an approval with conditions. What kind of conditions can you get? Well, you might get conditions. Well, give me another pay stub. Provide a letter why you lived in so and so address. Why this deposit. What's deposit. You have to certain explanation that you must provide to the underwriting to get it clear. Okay. Now, how long can you get a conditional approval? It's up to the lender. When they do step number one, you get the contract, goes to processing. So you could get an approval, a loan conditional approval. Like I said, it has to be very organized. If you have a file or someone that is not organized, then that's when the loan approval gets messy. Oh, I have to get an extension. I didn't get the right documentation. I didn't submit it right. I'm talking about the right step to do it, because a loan approval you could get in 15, I'll say max 20 days. Okay. I'm not throwing no one under the bus. I'm just telling you that if you're getting loan approval in 30 days, there's something's wrong. I mean, that's when you got to have an honest conversation with your lender and be like, I need my approval, my commitment. Let's say, in 15, 20 days. Why? Because if you write 30 days in your contract and your offer, the listing agent is going to review it. Remember that. The listing agent is analyzing your contract, your offer. So even though you send a strong offer, but if you're taking 30 days to get a loan approval, then the listing agent might pick someone that is going to give it to me in 20 or 15 days. Okay. Remember, when the loan officer does the pre-qualification approval, that loan should get approved by underwriting. Do that make sense? If step number one is done correctly, then once it goes to processing and underwriting, it should be approved. So the loan officer is the one that has to be qualifying the buyer correctly. I mean, I'm telling you right now, step number one is going to give you number four, the conditional approval. The underwriter doesn't qualify the buyer. They're not the one, a lot of lenders, loan officers, oh, the underwriter's fault. No, it's not. It's not the underwriter's fault. When you hear that word, oh, because the underwriter, you ask the right question. What happened? Okay, tell me what happened. Did you able to, did you look at the documentation for the beginning? Did you did the debt to income ratio? Do you analyze the monthly debt? See, those questions have to be asked. And I'm telling you this because that's what goes behind the scenes when your file, your contract is with the bank. Okay. So you got to ask those questions to make sure that when it goes to underwriting, you get the loan approval, which is the commitment. Back then it was called loan commitments. Send me the commitment. But the commitment said conditional approval from underwriting. I want to make that clear. Now, that approval is going to have conditions. But Jose, but why does he have conditions? Because he's going to have conditions. Because remember, they also review the appraisal. They're also going to review the insurance. And they're also going to review title. So, I mean, when they say review title, remember, when we get the documentation from title that I was ordered step number 3, we have to make sure that that it's good, that it's good to go. So, and if they don't provide the documentation, that's part of it, of the conditional approval. So they might ask for another bank statement, letter explanations, deposit, sorts of deposits. The co-borrower couldn't, they couldn't get the right documentation at the beginning, so now it's updated. So you want to minimize, as the less condition you have with the underwriter, the smoother you're gonna close on the transaction. Okay, so it's very important when you're asking for the loan commitment, loan approval, it's the same. And if you ask, well, why does it have conditions? Normal, it's gonna have conditions. Now, those conditions have to be met. Okay, because we're gonna go to step number 5. See, once the loan officer receives the conditional approval with conditions, the loan officer is gonna go to the buyer and say, hey, I have my approval, congratulations. These are my final requested items. to be able to close the transaction. Okay? These are the final. Yeah, but I gave you everything. No. Yes, you did give me the preliminary documentation, which is that's why I got you approved. But now I need my final requested item from item. So like that they don't get confused that they might think they're asking the same thing over and over, but it's not. It's just kind of similar but different documentation. So as a real estate agent, you understand that it's going to be other conditions. They might need an addendum, maybe an FHA addendum that was not included from the beginning. Anything related. If it's going to be seller contribution and it was negotiated after the inspection, so then that's part of the conditions. You know, so that's what I'm saying. No, they're going to do another credit refresh. We're going to see that there's no new debt when we started the loan. Okay, so and like I said again, buyers can forget that they're buying a home, and all of a sudden they go buy a car, all of a sudden they go to Rooms to Go, and and they get a good offer, 0 interest rate, and they start buying furniture. You know, maybe the loan officer when he did the qualification was kind of tight with the debt to income ratio because the home that that they chose, the property taxes was a little higher. They had an association, so now you're like, eh. So you have to guide your buyers, lender, and real estate agent that do not, either lend the credit to someone else or be joint, so they could be joint account with someone, student loans. They cannot do anything. They have to maintain the credit intact because the lender is going to do a credit pool and it's going to confer new debt because it's a new debt and it affects the approval. Remember, the conditional approval is number 4. That doesn't mean they're clear to close. Once it goes to number 5, those conditions have to be met to be able to provide the final approval. That's the final one, and then they clear to close. So we're gonna do a quality control. We're gonna make sure that the bar is working. We're gonna call, hey, is Jose Mates working there? Yes. Is he gonna continue employment? Yes. Perfect. They're gonna do a final verification of employment. So if someone is planning to leave their current employer and is planning to move to another employment, HR, someone might say it, or they're gonna say it. I'm not saying might. They're going to say it. And guess what happened? Guess what happened? If that is really true, then it comes back to quality control that if they're starting a new employment next week, then your loan could fall through. Now we have to wait until the new buyer, that buyer goes to start the new employment and wait 30 days of pay stubs, 30 days of employment history. So you see what I'm saying here? Communication from the very beginning is very critical when we get to step number 3, 4, and 5. Because that doesn't mean you're already finalized, already got the approval, I could do whatever I want. No. This is when you have to stay put, be committed, because the whole goal, right, is to be able to go to closing. But I seen lots of loan keep falling through because the loan officer didn't ask the right question. Hey, are you planning to move for employment? Are you going to be self-employed? Oh, this is a tricky one. I'm tired of my job. I want to be self-employed now. If the loan officer qualifies someone as a W-2 with income, it's qualified, it's approved, DU, he went through all the steps. All of a sudden, he decides to be 1099. Then you don't have a history of a 1099 income, and that could fall apart as well. So when someone gets approved as a W-2 employee and they decide to become an entrepreneur, like, because it's a new thing, then that could damage your loan approval in the process. So you tell someone you're not going to be an entrepreneur when you buy a home, or you're not going to travel when you buy a home because we need you here. We need you here to be able to close on your home. This is the biggest investment. The biggest investment to most, these people are going to buy a home. This is the biggest investment. They might never buy another home, but this is the biggest one that they're going to have in their lifestyle. So you have to be, as a real estate agent, you have to be sharp. You have to communicate. If you're repetitive, even better. If you're nagging, even better. I like when real estate agents are very involved. I love that. Why? Because they're doing their job. They're following up. They're sending the emails with the timeline. Contract, inspection, 7 days. Loan approval, 20 days. closing date, 30 days or 45 days, whatever. Be thorough, follow up. This is your business. This is your small business. This is not your job. So you're supposed to be involved. I don't want to know anything about financing. Guess what? You do. You should. You want to know about financing. You want to know where you're getting into. Because the lender could tell you, could blame anyone, could blame, oh, the underwriter's fault, or it's FHA's fault. FHA has nothing to do with this. Because FHA is bad. They're not good. That's not true. The loan office is not doing the right job with the qualification, and you have to make sure they do it right. Don't pressure them. Oh, I need it now. I need it in 5 minutes. I need it in 20 minutes. Because they can make a mistake. Give them the right amount of time. And if you trust them and you have a good relationship, then you should be fine. You should be okay. So once you go to final approval, they have to meet the final conditions. And once you get the clear to close, then you know where we're going. We prepare for closing. Now, once you get the clear to close, or it could happen before, this is when they're going to obtain the closing disclosure. It's going to be emailed to them, to the borrower, to be signed 3 days before closing. I don't know if you heard it, CD is a closing disclosure. That's the terminology. So that's what it used to be called the HUD-1 back then. This is now the closing disclosure. It gets sent by email. Right now, all the application, all the loan process is done, it's done through online, digital, so they get it. All they got to do is e-sign. But this is when they're going to review the final numbers. Sometimes the lender sends the initial CD that it maybe it's not the final one, it's just to be ahead of the game. So they don't, once they sign the CD, we have to wait 3 days before closing. So if your closing date is today, the CD has to be signed 3 days before. If they sign the CD the same day of closing, you can't close. You can't close. You won't be able to close the same day. You have to wait 3 days after they sign the CD. You could count Saturday. If they sign the CD on Friday, and then it's Saturday, Monday, and Tuesday. So you're closing Tuesday. So that's one, that's one detail you guys got to pay attention. That when you have a closing date, the CD, the number has to be delivered 3 days before, and the number have to match, because this is when the lender has to be in communication with the title company, and they have to match numbers. So any application fee, real estate agent fee that you might have, please include it in the contract. If you have your, I know you guys have the processing fee commission of $395, $495, whatever the amount is, please have it in the contract. If it's not, and they do all the numbers at the end, and you be like, oh, what's my processing fee? Well, guess what? It won't be included, because by compliance, the buyer, the consumer must know all the fees, all the charges before closing. Okay. So like that, once they have the final cash to close, they see the escrows deducted, the appraisal deducted, anything that they pay up front. And I'm talking about inspections. We have nothing to do with inspections. I want to make that clear. We don't get involved in home inspection. That's something that they do for the peace of mind, to make sure the property is good to go. Okay. So I'm talking about survey, appraisal, and anything that they have done for the financing. Final inspection for appraisal. That's another charge that they have to go. So that's gonna be the final cash to close. He signs, we wait 3 days, and then the title company schedules the closing appointment, and you go to step number 7 and you close. Okay. Lenders do not schedule closing. Lenders do not schedule closing. Please don't call the lender, say, when are we closing, at what time? No, we send the package to the title company. Once the CD is signed and all numbers matches, there's a closer from the lender that is going to be communication with the settlement agent, title company, and they're going to send the package. The package is an email format that they print, the title company, and this is when they go ahead and sign the documentation, which is here, sign closing document. And once they sign, and well, I don't have the keys yet. Yeah, because you know why? Because once you sign the closing document, they have to be sent back to the lender, to the funder, to the post-closing. with the lender because it has to be recorded. So they have to sign a signed deed, a signed note, a signed mortgage to the lender. Usually, and I don't know if you guys seen it, it takes a couple hours. Sometimes they'll go to lunch, come back, and then we hand you the keys. That's because the title company is sending the closing docs to the lender to be funded. That's the proof that we got to have that the loan is signed and to be so we'll be able to fund. And that's when we send the ID to say, hey, the money is in the account. Go ahead and provide the keys. So when you go to closing and you sign, oh, here, give me the keys, I'm out. No, there's a process behind this. So you be patient. Tell everybody to be patient because I seen it that they get desperate. They want to get the key. They have the moving truck ready, and they get ahead of the game. And I would suggest to be patient, especially now there's a large volume of transactions financing. That this is the way it goes. So you see the roadmap is a curvy, transaction movement, a lot of moving parts. But if you understand what goes behind it as a real estate agent, and you understand the terminology, what's going on, and if the lender's not giving you a response, I would suggest to push, speak to someone, a branch manager, so a sales manager, whoever is involved running the branch, and the lender is not responding. Because when loan officer is not responding, then it's something's wrong. It is. You guys are smart. You know what's going on. If the loan officer doesn't respond to your emails, when are we closing, and what's going on, then there's something wrong. Okay. And as that's the Achilles heel for a loan officer. When something wrong, they want to hide. They think that problem is gonna go away. It's not gonna go away. They have to be upfront. If something wrong, listen, things happen sometimes. I'm not saying it's gonna go perfect. Things can happen. The buyer can make a mistake, could deposit a cash deposit, or maybe they missed the payment, or maybe the loan officer didn't send the right documentation. But it has to be, you know, as a real estate, you have to help, smooth the situation because this is a very stressful, transaction, especially for buyers that never gone through this before. So if you as a team with your lender work as a team and you guys, handle the problem correctly, then yeah, it happens all the time. Every file, every loan is gonna have a challenge. Even when that buyer walks on water, even when that buyer has a 780 credit score, it's always going to be something, but you have to have the right support, the right team. And as a real estate agent, if you know what's going on, you get involved, then you're going to be able to handle that. And you're going to have more transaction going on in your pipeline. Because the problem is a lot of realtors just get hung up in one file. They just it's mine. They get attached. And to me, what's going on. And that's good to follow up. But if the process is moving, concentrate and getting more files because that's when you're going to understand even more and the stress level is going to go down. Okay. So think about that. This is the whole picture. Yes, I mean, it's longer, but I want to give you what's going on from the beginning to the end. Now, let's move to the next slide. Oh, let's move to the next slide, which is completing the approval process correctly. And this is similar to step number one. As a loan officer, as a lender, we're going to verify income. We're going to ask for tax returns, personal, business for the last 2 years, especially if you're self-employed. If you're self-employed, we're going to get that documentation. I don't care if you make $1 million a year. I want to see what's your net income after expenses. Okay. Bottom line, we want to look for that. We want to see it. We want to make sure that you have it. I understand that a lot of self-employed don't want to pay taxes. Welcome to America. So we have to, that self-employed have to, if they're making money, then, and they want to buy a home, you have to be stern. This is what you have to do. If the lender's telling you what we need, then do it. Then make it happen. Give them the information. Okay. This is for self-employed borrowers. If they're employee, then we're going to ask for W-2s. We're not going to ask for tax returns. We're going to need the last 2 years W-2, last 30-day pay stubs. And then we're going to ask for bank statements. Why bank statements? Well, we want to make sure that you have, the down payment, cash to close, for you to close. Very simple. I've seen bank statements that they're like $2,000, $500, and asking, where's the money? Oh, well, I don't have it. I said, well, how are you going to buy? Now, they might tell me, or they might tell the lender, well, someone's going to provide me a gift. Okay, now we're talking. Or you know what, Jose, I don't have the money liquid in my checking account savings, but I have my 401k, I have my stocks, I have mutual fund that I'm going to liquidate some of that money and use it for the purchase. And that can be done. That's acceptable. Okay. So the fact that they don't have the money in the bank, that doesn't mean they can buy. You just gotta ask the right questions. Okay, so if you're getting the money through the 401k, this is the documentation I need. I need the once they're going to provide the financial advisor documentation, they're going to need a contract, they execute a contract, and they're going to need the loan estimate from the lender so they can see how much money, how much funds they need to be able to close in a transaction. That's a right documentation for them to obtain those assets from investment account, 401k, or anything related to that. So yes, so that could be done. Gift, investment account, 401k accounts to be able to use it for assets. Okay, verification of credit. We're gonna run credit. If someone's going to get qualified and they don't want the lender to run the credit, let me go to Credit Karma, let me go to any of those, particular website. So you're not getting the full approval, because I seen Credit Karma. Yes, it's okay, it's cute, but is it going to provide me what we need? Is it going to provide you what you need? Credit Karma is not going to give you the approval. You're going to need to, the buyer needs, we need to run credit so we can give you the best rate and term, not a Credit Karma credit score, because doesn't match. It's not the same. It's not, it could be similar, but it's not the same. It's not going to show the full account with the monthly debt. So you want someone to go through the process, and verification of credit is very important. It's critical. It must be pulled. If someone doesn't want to get it, so they're not serious. They're just looking. I'm looking around. No, you want someone committed. I want run credit, give me approved, and let's go forward. Okay. So this is when you complete the approval process correctly. If someone comes to me with no documentation, I'm not going to issue an approval letter. I'm putting my name on it. My name on is going to be in your offer. In the listing agent calls, which they do call, when they call the lender, hey, Jose, do you verify income, assets, and credit? What am I going to say? No. If I say no, then what am I doing? Well, I'm in the mortgage business. Yes, I'm going to say yes. I verify income, I verify assets, and I verify credit, and he's good to go. And he's good to go. We could close in 30 days. I could give you the approval in 15, 20 days. Let's make it happen. And this is when you give confidence to the listing agent. Because if you're working with your lender, the lender must get involved with the listing agent as well. Remember, these guys working as a team. So as a team, please have your loan officer lender to call the listing agent and say, my buyer that I approve is good to go. Now it's not just one. We're talking about a team calling. I'll go further. Have the title company call the listing agent. Hey, we're ready to go. I just need to execute a contract to order all the title docs. We're good to go. How powerful it is that you have a team behind you asking for the documentation. All they need is to execute a contract. This is the strategy way that you could have more value, and I'm not, and yeah, it's competition, but you want to obviously do better something than your competition, because you're active. We're doing this every day. So this is the process that you have to do it, the lender. Now, let's go to conventional programs. Conventional programs, which is the Fannie Mae and Freddie Mac. When you hear Fannie Mae and Freddie Mac, they're the same. Okay, conventional financing, which is right now where we're seeing the large volume of loans in the pipeline. Conventional financing came back strong, and especially now after COVID, these are the type of loans that are strong in the secondary market, that are closing. The rates are amazing. You've seen the rate how it is now. They're lower than 3%. I think 2.7, 2.8, 15 years, I think 2.3, 2.5. So it is activated. It activated the market to be able to buy a home. So conventional financing, let's start with this. Standard guidelines. What's the minimum down payment? A lot of realtors, they think that is 20, 10, no, 3% down. 3% down is the minimum down payment for first-time home buyers. Let me make that clear. First-time home buyers could qualify a 3% minimum down payment. If a buyer has a home already, this is a different scenario, real quick. If the buyer has a home primary, they want to buy another primary home because they want to upgrade, they want to go to a bigger place, then they have to go 5%. Okay, I wanna be clear on that. That 3% is for first-time home buyers. 5% down is for someone that is not a first-time home buyer but wants to move in on a bigger home, wants to upgrade, and it's gonna be his primary. Then that could be 5%. Okay, they don't have to put 20% down because 20% down is for investment. Now, what's the max loan amount for conventional financing? 510,400. So if you have someone, a buyer, that wants to put 5% down, just gonna give an example, and they see a property for 535,000 with 5% down, they're financing 510,000. So you could buy a home more than $500,000 with 5% down or 3% down. So that's how attractive. It's not a jumbo. See, back then that amount used to be called jumbo financing. See, last year the loan amount was around 470 something 474 last year. The year before 417. So the loan amount has gone up because the market, our real estate market has gone up nationwide too. So keep it in mind. If don't stay in 300,000. If your buyer have the capability to go higher with the debt income ratio, so you're gonna have more room, more variation of properties to show. So this is, as a real estate agent, you have to be in communication with your lender to say, hey, how much can he go, and have payments, because if you could go higher, let's make that work. Okay. Debt to income ratios. I seen approval for 50% debt to income ratio if DU LP approval. I talked about before. DU is desktop underwriting. That belongs to Fannie Mae. LP approval is called loan prospector for Freddie Mac. So what are the difference? Why Fannie Mae? Why Freddie Mac? Well, I mean, Freddie Mac could work with you if the self-employed borrower could get approved 1 year tax return. Now, a lot of people tell me, well, I mean, I'm self-employed. I started in 2018 and I want to do 1 year tax return and I'm good to go. No, it doesn't work that way. For Freddie Mac, if you wanted to get, and you're self-employed and you want to get approved 1 year tax return, you must be in business for 5 years. Your corporation has to be in business for 5 years. Okay. So it could give you an approval with Freddie Mac. Now I seen Fannie Mae coming along because they have two different guidelines, very similar but different. I seen Fannie Mae giving approval 1 year tax return, um, not having 5 years self-employed. I seen it less, but DU will do it if this buyer is strong. They have credit, they have assets, they're clean, their credit history is good. This is when someone has to walk on water, and they have great credit score, great loan to value, and DU could give you 1 year approval without 5 years self-employed. Okay, so I debt to income ratio, I keep it at 45 DTI, and a lot of people tell me, what's debt to income ratio? This is the monthly debt that the buyer has on the credit report, the monthly debt, plus the mortgage, taxes, and insurance, the payment. We add it up and we're going to divide it by the gross income from the buyer. That's how we determine the percentage of the debt to income ratio. It's a 45 standard. I think 50. I don't qualify everyone at 50% because that's suicidal. I keep it at 45. And if I run it through the U, it gives me 50% because maybe it needs a push to go higher, then why not? So it's all up, you have to work it. You have to work it. It's not a box. The guidelines are here, but you're able to work it. Okay, 100% gift. And if the buyer is short cash to close and they don't have enough money from the 401k or maybe their liquid assets, it's not enough because that happens. So a family member is willing to give a gift to the buyer, And how do you document a gift? Well, Jose, I have $5,000 cash. Can I do it? No. Cash funds cannot be verified. We can verify cash. Even if you had it in your bank account for 20 years and you took it out, a year later and you have it in your home, $5,000 cash is not going to help the cause. They have to be the way you document a gift is family member has an account, has the money in the account, does a wire transfer or give them a cashier check or personal check, whatever is easier. Once that, those funds clear in the buyer's account, we're going to get proof that they have the money in the bank. And we also want proof from the donor that that money came out from that account. So we have to source it, we have to track it, we have to connect it, that the gift is approved. Okay. So that's how we have to see where the money comes from. The gift could also be sent to the title company, but we have to do the same thing. We have to verify where the money comes from. We do a gift letter, the donor, the buyer, or title company, and we could count that towards the transaction, the purchase. Okay, so seller contribution as per Fannie Mae and Freddie Mac. If you give 5% down or 3% down payment, the maximum seller contribution is 3%. 3%. Okay, if the buyer's giving 10% down, 10% up, then up to 6% seller contribution. So if the seller's willing, I haven't seen that many seller contributions, but I want to let you know. For conventional, they're giving 5%, 5% or 3% down. Max seller contribution is 3%. Okay, we talked about the self-employed. We talked about the W-2 only for employees. If someone's an employee, you don't need to get tax return. We could just use the W-2s plus the pay stubs to qualify. Minimum credit score 620. I think it's very good. Right now the way after COVID, a lot of loans went on forbearance, but the market picked up, so they leave it at 620, and I think it's a great credit score to work with. It's not too low, it's not too high. 90-day flip. 90-day flip. This is for conventional. If you never heard about this, for conventional financing, an investor that works buys properties in the court and does the renovation, and repairs the property and put it back in the market. For conventional financing, there's no seasoning. If they bought the home for 200,000 and they're selling for 280 or 300,000, a new buyer that wants to buy the home has to be conventional approval because there's no seasoning to be able to buy that home. Because I'm going to explain to you now that with FHA, the buyer, that property needs to have to have 90 days on the market already for an FHA buyer to buy. But I'll explain that now, the difference in that. So let's go to FHA, which is the Federal Housing Administration. This is for most first-time home buyers use its programs. Why? Because it helps them. What's the minimum down payment? 3.5% down. 3.5% down payment is the minimum. Goes up to $373,750. Debt to income ratio goes up to 56%, almost 57. It's very high. We have to, lenders have to be careful that when someone goes that high, you have to know why. Do they have compensating factors? Do they have the money? Are they self-employed? They just have the income. They just declare less. So FHA could go higher than conventional financing. I showed you that on the slide before. So, sorry. We will go up to 50, but the standard is 45. So FHA has more room to qualify someone. Obviously, you have to run it through DU in order to get that approval letter. Okay? So FHA, when you see it, but my buyer's FHA approved. But you have to know why. Do they have okay credit? Does the debt to income ratio is higher than conventional? So those are the things that you have to know why FHA and conventional. Ask the questions. We keep it on a 620 credit score. Maybe there are lenders that are doing it for less. The lower the credit score on FHA, the more documentation the lender is going to ask. It could end up to be a manual underwriting. You don't want to go through a manual underwriting, honestly. They're going to ask for, DNA and everything. Just put it that way. You want to have your buyer to have 620 and up. If they need help with credit, maybe the lender could help them improve, maybe pay some of the accounts and improve the credit score. We'll touch on that later. But you want to have a credit score above 620. I mean, for you, for your transaction to go better, the lower the credit score, the harder it's going to be, because I've seen it, and it becomes more documentation, more tedious, more probably extensions, and you want to have a good experience. Again, 100% gift, someone could cover the down payment, closing costs with a gift, 100%. There's no minimum. Now, the lender wants to see that the buyer has, you know, some kind of savings, at least 1 month's reserve, because you don't want to prove someone lend and close and maximize someone's ratios, and then for someone that maybe has a flat tire and can't pay the mortgage. A lot of the forbearance loan that happened after COVID was FHA financing, because maybe a lot of lenders push someone at that type of ratios. Maybe the credit score wasn't well documented, and the credit scores were lower. So you want to have your buyer to be able to buy a home and to stay in their home for many, many years. You don't want them to call you back, hey, I can't pay it anymore. You know, if that can happen, that happens, yes. And is that going to happen later in the market? Yes, of course it's going to happen. But you want to have your buyers to be able to buy a home and be in their home for many years, because they're going to call you back. They're going to give you referrals. They're going to give you referrals. So if you do a good service and help them with the right program, they're going to believe in you, and they're going to refer you all the family members and friends, because you did a good deed. You guide them through it. Okay. Don't push a loan just because you think they could qualify. Help them go through the process. They'll appreciate that. 6% seller contribution. Uh, Fannie Mae, like I said, if you give a low down payment up to 3%. FHA, if you're giving 3.5% down, the seller could contribute up to 6% seller contribution. That could cover pretty much the whole thing. Closing costs and prepaids. What are prepaids? Escrows, insurance, taxes, closing costs, recording stamps, title, lending. So all that combined is I've seen it less now. It shouldn't be more than the 6% unless the taxes are very high on insurance. Okay, so seller contribution will go up to 6%. I haven't seen seller giving that much, especially on the sellers market. But just I want you guys to know that. We run through DU, LP, money underwriting. We use DU for FHA as well. So if you ask for a DU approval and it's FHA, we could provide that. Even though it's a Fannie Mae system, we could also use it for FHA as well. We could also qualify someone with W-2s as an employee, and the monthly MI factor for FHA is 85% for the life of the loan. So if someone is financing FHA with a 3.5, the MI, the mortgage insurance, is going to be for the life of the loan. Okay, unless the refinance. If they have 20% equity, then it's better for them to refinance conventional, remove the PMI, and you start a new loan. FHA is not going to remove the PMI if you reach 20%. That's not going to happen. Okay, so you have to on a conventional, not conventional. Let's go back. Conventional, when it's 3% down, or 5% down, 10% down, 15% down, you're gonna have PMI, private mortgage insurance. You're gonna have it unless you give 20. You won't have 20, mortgage insurance. Now, how long does the mortgage insurance last? It all depends. The lower the down payment you give, the longer it's gonna last. It could be 7 to 8 years, and it also depends on the market. If the real estate market in that section is going up, if you feel like it's going up, then you could call the bank and request removal of PMI without refinancing. Maybe they allow you to do that. Maybe they could send an appraisal. It all depends on the bank's, regulation standards. And some banks says no, you're gonna have to refinance. Some of them say yes, but the PMI will cancel at 78% loan to value, not at 80. You can ask for a removal if you don't refinance to remove PMI, but at 78%, it will cancel for conventional finance. So if you give 15% down, the PMI is going to be very, very small amount. It's not going to be that high, and you have a better way to remove it. So if you give 10% down, also as well, it's going to be medium price, 5%, 3%. If your credit scores are high, then the PMI will be lower. If your credit scores, is lower, then the PMI is going to be high on your payment. That's when you say, well, what's better for me, conventional or FHA? Because FHA is 0.85. For conventional, if your credit score are like 680, 690, then it could be more than 1% PMI. So this is when you have to compare which loan is better for the buyer. The lender has to be very, very savvy, to guide the buyer and tell, okay, this is where your payments are going to be better. Like I said, interest rate, both programs are very attractive, are very good. And if you have one tip, if you have great credit scores, if the buyer has great credit score, then I will go conventional because my PMI is going to be lower. My rate is going to be, attractive too. It's going to be lower. And I'm able to do a 5% down and it's going to be better than FHA. Okay. So FHA, like I said, it has to be because I don't have enough money. I only have 3.5% down, 1 month reserve. My ratios are high. And I need FHA because interest rate on FHA is going to be low too. It's going to be very attractive, but I don't want my PMI to be more than 0.85. Okay, and that's the calculation we use for AMI. That's the AMI factor. Okay, government second allows. So FHA and conventional allows down payment assistance. So if your buyer is looking, to go through a down payment assistance, it's like a silent mortgage that is going to be in the transaction. It could be 7,500, 10,000. I think 15,000. The buyers must go through an education course. It must go and have that certificate to be able to participate in down payment assistance. Obviously, it depends on the zip code, the county, and the availability of funds. Remember, if the seller allows for you to work with a down payment assistance, by all means, you have to analyze if your offer. Remember, you're competing. If he's gonna get accepted, if you're going with down payment assistance. So analyze who's the seller, where's the property, how much action they have. If it's a hot home, that hit the market, and if you come with a buy with down payment assistance, I don't know how the possibility they're gonna get accepted. So you have to analyze that. That we have it, yes, it exists. The down payment assistance. Also, they have a large volume. Also, people are applying. So you have to keep it in mind who you're working with, listing agent, and how long it's going to take for this type of transaction. Okay, so let's move it along. Now we're going to the benefit of VA loan. VA loan is a great loan for veterans. It's very similar to FHA when it comes to interest rate. They have low interest rate. I think 2.5, 2.6, 2.7, depends on the credit score. No down payment no down payment required. So that means the buyer could purchase a home with zero down payment, 100% financing. Okay. They need to obtain the certificate of eligibility so we can read the benefits of that VA veteran. Okay. If they don't have that, certificate, we're not going to know either they're exempt on the funding fee or they're not. Funding fee is a fee that the VA has that could be included in the loan or they pay out of pocket. Some people, most of the buyer wants to get included in the loan to get a finance, the funding fee, but it has no mortgage insurance, unlike conventional FHA that has mortgage insurance. So they could get 100% financing with no mortgage insurance. The seller could help, towards the closing costs. VA is very lenient, when it comes to credit, when it comes to bankruptcy, when it comes to foreclosures. I think VA buyers that they have foreclosure for 2 years, short sale for 2 years, and they're able to buy a home. We run it through DU as well. They had a bankruptcy and it happened a year ago, 2 years ago. I seen DU approving that VA. They're more lenient. I think that they got higher debt to income ratios. It has no prepay penalty. The other loans don't have the prepay penalty either. So they have a lot of benefits. The only drawback that I see on veterans loan is they have to do the termite inspections. Sellers don't like that. They're rather not to deal with that. The appraisal could take longer because VA have to review the appraisal. So appraisal could take longer than when you compare FHA and conventional financing. That once you order the appraisal, they're good to go. We get that appraisal report right away. VA have to analyze that appraisal. They have to give the notice of value, the NOV. So On a veteran loan, the lender has to know how to originate these type of loans. You know, they have to be very savvy. They have to understand the pros and cons. And is it a great loan? Yes, but we're in a different market. So the seller also have to know that the buyer is a VA and they're doing a VA loan and they have to comply. You know, the closing costs are a lot less on a VA than FHA and conventional, but they have to be able to qualify. You know, a veteran have to be, you know, it's not like I went to the armed forces. That's what we need, that certificate of eligibility to make sure they're qualified. Okay. And let's go to the next one. Let me see here. Q&A. I'm gonna answer. I'm gonna try to answer all the questions before it's over. Uh, Now, breakdown of the mortgage payments. The breakdown. So, lender qualified, going to qualify the mortgage payment with principal, interest, taxes, insurance, PMI, and association, HOA. You know, when we're doing a qualification, you must provide as much as possible information to the lender. You know, remember, right now, property have property, you know, higher taxes than others. So if you're working with someone that their debt to income ratio is very tight and the lender's doing numbers, help them. Say, hey, send them an email. This is the MLS, you know, because there's certain areas that taxes are higher and that they have high association. And it has to be included in the qualification, in the approval. It has to be. Even they pay quarterly, even pay yearly, it has to be part of the approval. So we're going to use the principal, interest, taxes, the right taxes. Sometimes we could assume and have a use a percentage, but I rather ask the agent, please, if the taxes are lower, we could use that. Now you have to let the buyer know that if they're using low taxes, because that was probably the first owner, they have, homestead exemption, veteran, anything, that those taxes are going to go up the following year, and that payment is going to be higher the following year. So you want to be very careful how you're going to calculate taxes, especially when they're very low, because if you close, let's say at 350,000, 375, those property taxes are going to go up, and they're going to think that, hey, so what happened? Why my payment is higher a year later? Because you're short on escrows. You're going to get a letter from the lender, be like, hey, your escrows are short. Now you either pay this much, or this is a new payment. So we have to be careful with that. If the taxes are higher, then obviously they're gonna have to apply for homestead exemption in January if they close this year. So like that, they could get that discount, and the following year, November, they could be able to, if the taxes are lower, then they're gonna pay lower. Insurance, homeowners insurance. Remember I talked about on step number 3. When they do the home inspection, please tell them to include the 4-point or mitigation. That's going to help them for the insurance, because right now homeowners insurance are high. There's less carriers in Florida. So Citizen, all these companies are coming back with high premiums. So if you include a 4-point and mitigation, it's going to help the buyer and the lender to be able to get that quote right away. They could shop around, or the lender can help, or you can help and get at least, 2 or 3 quotes, the best one with the right coverage. And if it's the ratio, then go for that. Don't wait till the end. Don't wait until your appraiser comes back, survey comes back, loan commitment. You want to get that insurance before, because remember, that can make or break a loan too. Because the lender did numbers, and they calculate 3,500 insurance. If it comes back at 4,500, then my ratios are not working. This is when you have to go back. Oh, you're gonna have to pay some account, include a co-borrower, more down payment. So it becomes very, very stressful. Maybe it could happen, maybe it cannot, but you want to have that insurance quote included right away. Why? Because this is part of the debt to income ratio payment. Okay, it has to be included. Even if you give it 20% down and you want to waive escrows, you don't want to have it included in your mortgage payment, it don't matter. We have to qualify you with everything included. Yeah, but I don't want to pay tax. I want to waive it. It doesn't matter. You have to qualify. Listen to the word. You have to qualify to get a loan, because the bank, you still got to pay those taxes regardless if you're paying yearly, quarterly, whatever how you choose how to do it on your own. you still have to qualify. You still have to pay for it. So that's part of the equation. That's part of the qualification. Homeowners insurance, homeowners association, real estate agent. If that property has it, please let the lenders know. Hey, this has an association. How much? 300. Oh, okay. Now let me go back to the drawing board. You know, the more ammunition you have, the more information you have, like I said before, the smoother transaction is going to be. If you caught it and that doesn't work, the ratios go up, the lender has a chance to say, hey, you know what? Can we include your spouse? Can we include someone? Can you pay off this, account credit card? So, we're able to, put in the, calculate the association. These are the ways that you, as a lender, they have to work with you, and give you that service and give you the ability to be able to make it work. Okay. So, but also give them the information. Don't assume that the 400,000, the tons of property with different property taxes that maybe didn't have home tax exemption, insurance. If those homes are older, if those homes are older, the insurance is going to be higher right away. So you have to make sure what type of property the buyer is getting into. Okay. So the insurance company is able to, insure the file. Remember, we don't get involved and who you're going to obtain insurance. If the insurance company is going to give us the, you know, the certificate and it's insurable, then we go forward. So they have to make, if they have to do some work after to lower the premium, that's with the insurance company. So keep that in mind, okay? All right, so increasing your credit score. Okay, so buyers right now want to buy. They're looking to buy. They don't understand credit. Credit is um, it's very complex. A lot of people think, oh, I have 5 accounts and I'm good to go. Yes, but what's your credit limit? Are you paying on time? Are you maximizing your credit? Yeah, I'm only paying the minimum payment, but my credit's still low. Well, if you lower that 30, 20%, then you're going to see an improvement on your credit. Okay. That's the way. See, credit works with activity. Activity, you pay, you keep your limit. Credit doesn't work that you apply, to 10 credit cards and you use them and you're good. No. Yeah, that's how that one you get in trouble. If you have, it's okay to have credit. It's okay to have credit card. It's okay to have a loan. This is the way the country works with that, right? But if you manage that and you don't go crazy and go all over time and buy stuff, that's when you get in trouble because your income is your income. But if your debt goes higher, there's no way your income is going to be able to afford that. So, but if you use your credit wisely, and some people say, oh, I don't believe in credit, I don't have credit. But sometimes it's not going to help you buy a home. So I would suggest if you don't believe in credit, to believe in credit, but if you want to use a credit card and instead of using your debit card and use the credit card, use, for your utilities, gas, Publix, whatever, then pay it off at the end, that's going to help you even more. That's going to help the buyer even more. Obviously with timely payments. Some people, oh, I'll pay the day after. Well, guess what? That could be a late fee. A late fee is going to destroy your credit score, no matter what. Yeah, I'll go ahead and dispute it. I'm going to make a dispute because I paid on time. And guess what? Dispute is not going to help you either. A dispute is going to put a hold in your credit, in those accounts. And you might think that you did something wisely and you're able to beat it. But when you want to buy a home and you have 4 accounts that are in dispute, right? Because you don't agree with the creditor, then when it goes to DU or LP, they're going to read that. Say, hey, there's 4 accounts that are in dispute. They have to be on dispute. So you're going to have to go back and take away the dispute and run credit again so your credit score could be valid. Because when you have accounts that are in dispute, you want to buy a home, the underwriting system is going to pick it up. It's going to say you have accounts that must be on dispute. If you have a balance, if there's 0, then whatever. But if you have a balance and you think, oh, I'm okay, no, you have to be on because you don't have a valid credit. So you must take it out to be able to read it and have it right. So this is when it gets challenging, when it comes to credit. Become an authorized user of someone's card with a great, yeah, you could do that, of course. You could be someone, your spouse, or join and authorize, and if they're doing well in that account, that's going to help you and improve your credit score. So that's another way how can you improve your credit scores. I mean, make frequent payments, I mean, number one, that's going to be the number you have to make payments. If you could keep it at 20%, 30%, then you're gonna begin also mix it up. Not just credit cards. Like I said, installment account, fixed payments. You know, student loans. Right now it's a new thing. Right now they're all deferred, and if you don't pay student loans, and you think I'm gonna be okay with student not paying, that's like an IRS, account. Like a student loan, you must pay. If you have to pay, you have to pay. If you want to defer, you want to extend it, that's fine. You know, and if you want to extend it for another year, and the payment is a zero payment, then as a lender, we don't have to count it if it's a zero payment. If you have to apply for the income-based program for student loans, then the monthly payment they give us, we could use that, or they graduate. So you know, credit is very important to buy a home. Do you have to have the best credit history? No, but you just gotta be organized, and whatever you have to be responsible. So for the lender to go ahead and give you an approval, and not later on say, oh, by the way, you have to remove those dispute. Because when I run credit and I see it, dispute account, it could be okay. I could run it through it, but if the lender doesn't catch it, then that could be also a nightmare. So you want to have the ability, the lenders to read credit report. If they need to, if they need to get it fixed by someone else, like a company that fixes credit, then that's something different. I would suggest for them to analyze who's the company, how successful, the turnout, and if they have testimony. I mean, to someone to fix the credit has to be really bad, you know. But if the buyer just need to go ahead and prove 10 points, 20 points, and they have the accounts to do it, by all means. Can they open a secure credit card and use their own money to improve credit? Of course, they can do that. You know, they go with two or three of those, and instead of using your debit, use a secure credit cards. They could go to any bank and open that. Credit unions, any banks, big banks, they have those accounts. That they're going to run your credit, yes, but that's another way for the buyer to improve their credit score. Okay, if they want to call directly to the bureaus and handle that themselves, of course they could do that. They don't have to pay someone to do that always. They could do it themselves, but then you have to exchange your time to be able to be back and forth to be able to fix it. So it all depends, where they're at. Okay. Now, technology. So the roadmap that I just showed you guys, a lot of lenders are implementing platform that they could just, give the real estate agent, where the loan is, from the beginning, from processing, underwriting, when they run credit. I seen it now. Even real estate agents are being, in the same communication with emails. Okay, the loan is in processing. The loan got approved. The loan is approved with conditions. It went back to see realtors are getting the process in a digital way. Back then we didn't have that. So if you're working with a lender and it has a platform that could give you updates at all times with the loan, that's valuable right now. So the lender that you're working with, ask for the, hey, do you have a platform that could let us know, where the loan is through email, text, or if they want to call you, even better, of course. But you also want to have everyone involved, so you don't have to out of your day call 5 lenders to see where my loan is. So if you have that roadmap that I just talked about in a digital platform with your lender, then by all means that works. And that's going to keep everyone involved. It's going to reduce the stress level where my loan is, because sometimes the problem is there's realtors that tell me, well, I haven't heard from the lender in 5 days. I don't know what's going on. They haven't replied my email. They haven't called me back. I'm really worried because my seller has to move out. They're buying another house. And that could be critical. That can make or break a transaction. The trust level could fall apart. So if you're a buyer's agent, listing agent, and have everyone communication, so like that, your seller or buyer are going to be at ease. Because remember, people go to work. People go to work. They're doing anything. They don't want to be, paying attention. My loan is falling apart. So if you have a lender that give you updates where the loan is, and they communicate, and they give you that phone call at the end, that's going to bring more value to your transaction. Okay. So now let's go to the Q&A questions. This is my favorite part right here. So let me go to the chat. How's the presentation? Is that okay? Good? Let me see. Okay, so quick question. Perfect. Thank you, Dominic. Let me go ahead and answer some questions. See, a quick question. Can you take the home price, multiply by 25, get an idea what kind of income the buyer need? I mean, when it comes to income, you have to, I mean, you want to have the lender to analyze that when it comes to income. You know, you want to be able, like I said, you want to use the monthly debt on credit, monthly debt, minimum payments. Then you add it to the PITI, what I just showed, principal, interest, taxes, and insurance, and divided by the gross income. When I say gross, someone that is employee, that is, if you make $5,000 a month as a gross, that's the income that we're going to use. If you're self-employed, we're going to use the net income, that final adjusted net income. Like they make $100,000 a year, and their expenses were 50,000. 50,000 is what we're going to use. Okay, so that's the best way that we calculate income. And remember, when you do payment, if you want to help, if you want to do monthly payments and give a payment, I don't suggest you to do that because remember, you have the PMI factor. You know, this is when things could be different. If they're giving 20% down, then you use the taxes, pay the property taxes, you can calculate some insurance, and then get some kind of interest rate, whatever's in the market, and you could do the debt to income ratio. But if he has PMI, I would suggest the lender to do that. Okay. Question number 2, what are the requirements if you self-employed 1099 to apply for a home? Last 2 years tax returns. Okay. If you're self-employed, you must have 2 years. Okay. 2 years, not 1, 2 years. So it must be income that is declared income. Like I said, if you have just a 1099, if you haven't done your taxes, that's not going to work. You have to go to your accountant. And remember, as a 1099, we don't pay taxes when we're getting paid. There's no deductions. So it's all gross. So you have to go to your accountant and for them to do the taxes. So you must have 2 years for self-employment. Okay. If you were W-2, I'm going to give you an example. If you're a W-2 employee and all of a sudden you became 1099, you have to have 2 years. Yeah, Jose, but I have W-2 employee income declared. So what? That's a different type of payment structure. Structure that you're getting paid. It's different. As a W-2, we're deducting your taxes, your FICA, your Social Security, and you have a net income every month. As a 1099, I don't know how much you're gonna end up making. Because you get paid commission, you get paid. So that amount could fluctuate, and you could be a different amount at the end of the year, and then you have to do your own expenses. Okay, so. How and when do you know if property condition will qualify for FHA financing? If representing the seller, what's good practice to verify this at time of listing? So, okay, properties have to be livable, okay? They have to be livable. If they're original and they're old and they're original, that qualifies for FHA or VA. Now, the only thing about VA, they're gonna ask for a termite inspection. If they do the termite inspection, and he comes back and it has to be treated, then it has to be treated. That's when they have to go back and treat the property and fix it. So this is when VA could get very, the seller won't like that because, but in Florida, the buyer could pay for the termite inspection. In other states, the seller must pay the termite inspection. So if the property condition is livable and it's lot and block, it could be a townhouse that the legal description says lot and block, the UK FHA. I'll speak about condo a little bit, but yes, property conditions could be livable, let's say. If they need major repairs for conventional or FHA, then it becomes a different type of loan. This is what becomes a 203K, homestyle renovation that needs a general contractor. It becomes more extensive, more tedious, and all the repair has to be financed in the loan. So it all depends, okay? Okay, if I have a client who wants to buy a house and take his father-in-law who is retired and his brother-in-law who is disabled to live there, can they include the income in the evaluation even if they don't live with them at the moment? If they're going to live with him, okay, if family members are going to live with the family member and they retire, and his brother-in-law is is disabled, and they receive disability or retirement, you could use that income to qualify. Okay, they become co-borrower. Now, if they're not going to live in the property and they become non-occupant co-borrower, they could also help. Okay, so whoever wants to help on a mortgage, if you have a buyer that can qualify by himself and they want to use the parents, anyone, family member, if they're not going to live in the property, this is what is called non-occupant co-borrower. You could use their income. We're gonna also count the debt for the debt to income ratio. Okay, so if you have someone in Florida and you have a father-in-law or a parent that lives in New Jersey, I'm gonna give you an example, and they want to help the buyer, they become a non-occupant co-borrower. They're not going to live there, but we could use their income, their credit. The mortgage debt's gonna be in the credit as joint. Okay, so you could use family member even if they live in another state to buy. They're gonna provide more of a push to be able to, and we could calculate the income and the for the mortgage. Okay. Next one is, can it be a smaller play for not a first time buyer, two people on the deed for the first home? They're splitting now. Okay. I mean, it all, listen, if someone's buying a smaller place, I mean, you have to, and they own a home already, they own a home and they want to buy something smaller. So, I mean, it has to make sense. It has to be, they're splitting, they're not married. They have nothing to do with that. I mean, they could buy smaller place. It cannot be, remember, you have to know what's going on. You're not going to have someone that owns a home and then be buying something smaller because it might be an investment. Okay. So if it's going to be a primary, it has to be explained to the lender. Remember that. A lot of people they have their own home, but they want to buy another property with a low down payment and it's going to be an investment. That's not going to fly because they're going to go, why, if you live in a single family home and your tax return, you have kids, 3 kids, what do you mean that you're buying a 2-2 condo? Doesn't make sense. So it has to make sense. If there's single and they're buying something smaller, there's it has to be an explanation to the lender, and it has to be the truth, pretty much. So case by case, yeah, it could happen. How does it work with the financing for realtors since commission are the main source of income? Same thing, 1099. You have to declare your taxes because you guys are 1099, commission based, or if you have your own corporation, you're self-employed. Last 2 years of taxes declared. You guys are not W-2. You guys are 1099. So if you have your PA or your S corp or your 1099, you must declare tax returns to be able to buy a home. Okay, not just your gross. Remember that if you make $100,000 a year on real estate and you put $80,000 expenses, guess what? 20,000 is what we're going to use. The lender's going to use. Okay, the bank, anyone is going to use that. And I'm talking about loans for FHA, conventional, no, the traditional loan. That's what we're talking today. There are other loans, portfolio loans, that they're going to go based on bank statements, that they're going to go based on the property cash flow. That's what we call portfolio loan. That's something completely different. Okay. For anyone that is commissioned, real estate agent, anyone that gets 1099, and they want to, because conventional have the best rates right now. If you want to get a lower rate, then you want to have your taxes being declared. So it's kind of give and take. If you do a portfolio loan with bank statements, the rate's going to be a little higher. Yeah, it's going to be in the high five, probably low sixes. So it all depends, when the down payment that you're given in credit score. Okay. Next question. And for VA loans, seller may have to make repairs. Uh, most of it all depends what the home inspection it is. If the appraiser goes in, if the appraiser mentions anything that have to be repaired, yes, the seller has to make the repairs. Yes. If they see a leak on the roof and it's obvious, you see it on the wall, the floor, the tile is, you see that is mold, and the appraiser makes a comment subject to, the seller must make the repair if they want to close with financing. And that's with, not just with VA, FHA and conventional. An appraiser goes in and he's not an inspector, but if he's obvious and he mentions in the appraisal, hey, the floor, the roof, the baseboard outside is peeling, it needs to be painted, needs to be fixed, then it has to be done before closing. Okay, and that's not just on VA, but also FHA and conventional. I want to make that clear. It is true that new construction lenders assume as taxes 2% on the value of the house of the first year payment for new constructions. Because I know there's like Lennar and D.R. Horton. I mean, I have financed a lot of Lennar homes, and we used to use 1.2, 1.5 probably max, not 2%. Maybe that lender specific wants to use 2% for them to cover the butt. Okay, so maybe the lender has that overlay to use 2%, which is very high, but it shouldn't be. Probably, I'll tell you, they could go to, if you want to be, there's a website, miamidade.gov, that you could, do the taxes, estimation to see what will be, and include the purchase price and the address to have an idea what will be the property taxes in the future. But 2% is a little high. It all depends. Okay. Does DU LP approval state the type of approval on the letter? I see some approvals without a DU LP. What type of pre-approval on, or these are the one? Okay, so DU is going, LP is going to say if it's FHA and conventional. The way the lender has to specify, you include the DU, but also the approval letter. The approval letter is the cover letter. You say, so-and-so is approved, conventional financing, 20% down for $400,000, whatever. But include the DU in the same approval letter so you have both and identify the type of program your buyers approve. So you got to have the approval letter from the lender and include also the DU so it will go together. So it can give you the details. Yeah, because DU is remember, it has a lot of information that it could be overwhelming. It has a lot of pages. So the DU first page, it will say FHA or conventional, but it's not very, user friendly. So you want to have a cover letter and approval letter with the bank who's doing the loan, because DU is not saying who's the lender. The approval letter has to say it, and the name of the buyer, the type of financing, that they review the documentation. Make sure that your approval letter says they review documentation. Remember, DU, I could put whatever I want in DU. Let me put it this way. I could just go in, open the system and put $10,000 a month, $50,000 in the bank, and maybe I run credit, and I just go ahead and give you an approval letter. If your buyer hasn't met with the lender and you get an DU approved, then something happened. So you want them, because if I give you a DU and haven't looked at the documentation, then that DU is not good either. So this is why you got to have a great conversation, communication with your team, that anyone that you refer, you want to make sure that they actually qualify and went through the process. Make them go through the process. Okay. Dominic, thank you very much. Elena, thank you. Kayla, great presentation. Not clear about the DLP. Well, DU and LP, like I said, DU is for Fannie Mae, conventional. They're very similar. Most lenders use DU, okay? Which is the bread and butter. LP, loan prospector, which belongs to Freddie Mac, we have used if DU doesn't give you an approval. If DU doesn't like the file, because maybe it's like, the credit, the debt income ratio, the assets, then the lender could switch to LP, which is Freddie Mac, okay? They're both conventional. They're just two different institutions. And LP might like the file and might give you an approval. I've seen that happen. But DU is a lot more friendly, approve the loans better, and it's a lot cleaner. It gives you, I like DU a lot better because it's not too strict. No, LP could be very strict sometimes. The DU is more relaxed, more lenient, so I like DU better. Most lenders like DU better, okay? If someone has a bankruptcy, how long after can she or he apply for the loan? Great question, Felix. I probably didn't touch on that. So conventional financing, if you go through a bankruptcy, Chapter 7, you have to wait 4 years. 4 years. If you to buy conventional, if they want to buy FHA, then all they have to wait is 2 years, Chapter 7, okay? This is the one that Chapter 7, that's when you don't have to, they clean all the, the credit, you don't have to pay anything back. Chapter 13, it could be less, all depends after you finish paying all the creditors. You get the okay from the trustee. So chapter 13 is a little more complex, but chapter 7, when you wipe out all the accounts, 4 years for conventional, 2 years for FHA. And VA also is very lenient to that. So if you have a 2-year bankruptcy or less than 2 years, you can probably get it approved. Do you do foreign national requirements? I used to do foreign national, man, but right now we're dedicating more to conventional and FHA. Foreign national is a very niche program, Dora. Very niche. It has to be a lender that specializes in foreign nationals. It's very tedious. And remember, foreign national have to, all the requirements, all the documents have to come from their country. If they live in Colombia, if they live in Peru, if they live in, anywhere, the requirement have to come from there, like the accountant's letter or employer letter, bank statements. If they have bank statements in the US, we could use that. But we also want to verify bank statements in their country. They have to work there and they have to live there. Okay. A foreign national have to live in their country. If they live in the United States, it's not a foreign national anymore. Okay. If they live in the United States, it's not a foreign national anymore. Why? Because they might have a visa that they're working with and they're already working here, but they're not citizen, they're not a resident, but they're a domestic buyer. They qualify for a domestic buyer because they're already working here with a work visa. They have a social, they have credit, they have employment. That's considered, that's FHA and conventional. Okay. So if you have someone that is not a permanent resident or they're not a citizen and they want to buy and they have a work visa, guys, that's the domestic buyer all day. Okay. They must have 2 years employment here working. Okay. And at least when, they have to have the taxes declared. So, and we're going to verify the work visa. How's it going to last? Have they renewed before? Can they continue renewing that? So, it's an extensive process, but they could buy as a domestic. Can you please repeat the 90-day flip unconventional? So if you have you know, I don't know how's the activity right now on flips, but if you have someone that buys home and at the courthouse, and that's their business, and then they repair the property, they do the renovation, and some investors they're doing faster than others. They probably do it in a month and a half, and they finish and they back in the market listed to be to be sold. If it's less than 90 days, if he put the property less than 90 days, if he has 30 days, 60 days, then a conventional buyer could buy the home without waiting 90 days because FHA buyer and FHA buyer have to buy a home like that that's been in the market for 90 days. Okay. On the 91st day, then FHA and FHA buyer could buy it. On conventional, if the seller fixed it in 30 days, it's in the market, then he wants to sell it right away. Why not? Then a conventional buyer could apply to that. Okay. So that's the way it works. Can two-person can go together into a loan if they're not a relative? I mean, they don't have to be they're gonna. It all depends. Are they gonna move in together? If they're gonna move in together, then that's fine. There's people that are, that they're not married. They're partners. They're gonna live together, or they're friends, and they're gonna because, they're gonna go to, it's something that that is life. So yes, they could. They don't have to be relative to be able to buy. They could be family member, it could be friend. It has to make sense. It has to make sense. But yes, I mean, a lot of people here are not married, and they could qualify for a loan together. They don't do their taxes together, and they could qualify for a loan together. Okay. So, and everything has to be analyzed from the very beginning. So, any other questions? Let's see the chat here. Any more questions, guys? Let me see if there's more. Answer. Okay, let me see. Go to the chat. Dun. Okay, let me go to more questions here. Right. I will send you the presentation, the recording presentation, the slide presentation. If you have any questions later, you want to send me an email, text me. Definitely, I'm giving you this information so you guys are out there working hard. That the market is very competitive, and if you have, especially working with financing, with buyers, they're using financing. Financing is really, let me tell you, it's really good. A lot of people are buying now, and why? Because they're looking for a home office. They're actually building pools. They want to be able to work from home, remote. The way, every crisis it became something positive. Our market is became the top industry right now. And you hear the news right now. The rates, how the rates are going to continue being going lower. They're going to be the rates are going to maintain low now. Take advantage of that. These presentations that I made today for you guys for continuing, do webinars out there, do first time home buyers, you know, share the information because it's going to give you more buyers, more listings. And this is the time for us to educate because there's so many moving parts, and we are the one that have to share this information to make it happen. I mean, I've been in the business for it's gonna be 15 years. I started in 2006, and I love this business more than ever now because now we can do presentation online, Zoom, and we don't have to do it in person. When we get to do it in person, that'll be great. But schedule, do this presentation on the weekend, weekdays, and gather 20, 25 people and tell them that right now finance is working. Yes, a large volume, but you can help anyone right now. That's one thing. Who figures out? I'm going to talk about condos real quick before we go. Condos, yeah, yes, you could do 5% down, 10% down, 15% down, 20% down. Now, look into when it's conventional, look into the budget. Ask for the budget up front, 2020 budget, so we can check the reserve. No, don't do it at the end. Do this, the step number one, or once you get the contract executed or before, to make sure that the buyer is allowed to do a 5% down payment on condos. We want to make sure that they have 10% reserve. If they don't have it, we could split the loan in two loans um, with 15% down. We could do it first and a second. Obviously, when it comes to that type of approval, the buyer must have good credit scores. But if you have someone looking for a condo or FHA condo, spot approval, you must get the documentation. I can't stress it enough. You got to get the documentation. The fact that someone wants to buy a condo and you get the, remember, for condo, the seller is looking to sell right away. And not everyone qualify to buy a condo because association, special assessment, insurance, we have to verify that. And then the lender has to be also involved. So like that, you're able to have a transaction, on a condo to go good. If now there are things on condo that have the reserve, which makes it a lot easier. So you have to do the due diligence, get the 2020 budget, send it to the lender or whoever you're working with, so they can review before you order appraisal, inspections, and do the HOA approval. Okay, you don't want to let the lender let you know, oh, we need this. No, you be proactive. Be proactive. Um, okay, thank you very much. Can you use trust fund yearly income? Uh, uh, can you use it? You have to be declaring your taxes. Any type of income that someone wants to use to be able to qualify, like investment account that they receive on a monthly basis, they get interest. Every documentation that wants to use to qualify must be declaring the taxes. The only income that you don't have to is retirement, Social Security. Can you use child support? Yes, you can count child support, disability, alimony. You could count that. For child support and alimony, we have to verify that it's going to continue for the next 3 years. Okay, this is something the lender can ask this question when we get the documentation. Send us the divorce settlement agreement so we can see the income. Obviously, we have to make sure that it's deposited in the account. If I had the divorce papers, the settlement agreement, and I see the amount of $3,000 a month, and I don't see it in the bank account, then it's not going to count. It must be in the as count as a deposit. So that's what we're going to verify bank statements. If you say you get this income, prove it to me, or prove it to the lender, because like that we could fight for that and get that approval. You'd be surprised how many people could save loans when they have their income, but they forgot to say that they get Social Security or child support, alimony, and you're able to save that loan. Okay, so let me see one more question. If my client has great credit score and loan amount for down payment, which type of loan will be best for her? She's a first home buyer. But like I said before, conventional. If you have a buyer, a client that has great credit scores, and they want to give a 3% down, then go conventional. Go conventional because the PMI, the mortgage insurance, is going to be lower compared to FHA. FHA, like I said, it has to be a reason why they cannot go conventional. That's the option because maybe credit ratios, assets. So I will try to go conventional first if you have a great credit score. It's going to help also the offer. Listing agents love conventional. For some reason, they have a great, they have this feeling about FHA. But FHA is a great loan too. Don't discount FHA buyers. You'll be surprised how many people are FHA buyers and they really qualify. It's not a low income program, please. It's not a low income program. The reputation that FHA has in the street because a lot of people don't know how to originate it. They take too long, they fumble. Big banks don't understand how FHA works. They just want to get the vanilla buyer. And our business, we like that, but we have to work with everyone that we have. So the more education you give to someone, the better the buyer's going to be, and then they're going to come back to you. Okay. So can the buyer shop for loan with mortgage broker after he sends application approval? I'm new. Okay. Remember, a buyer could shop around with whoever gives them the best service and value. Remember, sometimes we get banks. Oh, my bank gave me a great rate, but they don't answer the phone. Jose, I'm calling the bank. They don't answer me. It's Saturday, Sunday. I'm showing houses. I need the lender to talk to me, but my buyer doesn't want to do it because they have great credit because they give them guys. Of course, they could shop around, but you want to stay with someone that's gonna answer the phone, explain the details. Remember the payments, the approval. So you guys can have someone reliable. And if you guys are showing houses and they have questions, the buyer don't have to rely on you on monthly payments and cash to close. Do that make sense? Do not get into back and forth with the buyer. What are your payments and cash to close? Because once the lender gives the final numbers, it could be a difference. So that's when you have to have a lender that is reliable and able to help you. Yes, they could shop around and for better service, rate and term, and they could close in time. Yes, you have to do that due diligence. You have to. Okay, so I think we finished the questions, guys. I thank you very much. Let me see. Let me see if I have one more. How is the process for loans to fix and flip? Well, I mean, to fix and flip, like I said, if you want to buy a home and to flip it, that's a different type of loan. Private money. If you want to buy property that you're going to flip, that's a conventional financing. Won't enter to buy homes and then flip. If conventional financing and FHA are for long term, minimum at least a year. Okay, so whoever's buying properties as an investment, either hard money or cash, if they're going to be for flipping. Okay, the conventional for investment is for long term rentals. All right. So, guys, again, thank you very much. I think we went over the time. I have a great Friday. I will get once I finish the Zoom recording, I will have all the emails and I will send this information. And if you have any questions, please reach out to us. Feel free to contact us. Okay. Thank you very much. Have a great Friday. Appreciate it. Thank you.